Hey everyone, welcome back to Corporate Decoder, the place where we break down complex financial reports to give you the real story. In this video, we're re-diving into Profusa Incorporated's latest filing, a document that is packed with numbers that tell a tale of a company navigating both exciting product development and some tricky financial waters. Before we start, if you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below where we discuss these filings and more. Now, Profusa is a company focused on medical sensors, things like oxygen and glucose monitoring. They had a big business combination back in July 2025, and this filing is showing us how that is playing out along with their financial health. Right now, we're going to look at their sales, their costs, and what their future might hold based on the numbers. So what exactly are we looking at here? Profusa is registering a lot of shares for resale by existing stockholders. Specifically, we're talking about over 42 million shares. This includes shares from a purchase agreement with Ascent Partners Fund LLC and other shares issued for transaction costs related to that big business combination they completed. It is a lot of stock, and it means a lot of potential selling activity. Let us set the scene with their stock price. As of early October 2025, their stock was trading at just $0.33 a share. That is quite low, and it tells you something right away about investor sentiment or market valuation for the company at that time. This document is a registration statement filed with the Securities and Exchange Commission. When a company files an S-1, it means they getting ready to offer securities to the public. In this case, it is related to those shares that are being registered for resale. Now, this is a really important statement. The company itself is saying there is substantial doubt about their ability to keep operating. This is something you see more often in companies that are struggling, and it is a big red flag for investors because it suggests they might not be around in the future without significant new funding. A big part of their strategy involves something called a committed equity facility. Think of it as an agreement where a financial partner, Ascent Partners Fund LLC, has committed to buy up to $100 million worth of Profusa as stock over time. This sounds good, but it comes with risks. One of those risks is dilution. Every time they issue new shares to this partner, it makes the existing shares worth a little less because the pie is now divided into more slices. And here is a curveball. Profusa plans to use the money they might get from selling shares under this facility to buy Bitcoin. Bitcoin, known for its wild price swings, adds a whole new layer of risk. They're essentially betting that Bitcoin's value will go up and that this strategy will be more beneficial than other uses for the funds. Now let's look at the financials to see what the numbers tell us. This table shows their financial picture as of the 30th of June 2025 after accounting for that big merger. On the asset side, they had about $14.5 million in total assets. But look at their liabilities, that is a different story. They had over $36 million in total liabilities, meaning they owed way more than they owned. The difference is a significant deficit. This number really highlights the going concern issue we talked about earlier. As of the 30th of June 2025, Profusa had a stockholders deficit of over $21 million. This means their liabilities exceeded their assets by that amount. It is a lot of red ink. Looking at their operations for the first half of 2025, their revenue was zero. Yes, you heard that right, no revenue. And their operating expenses were over $9 million, so they were spending a lot without bringing any money in. Their net loss for that period was almost $18 million. That is a massive loss. Interestingly, in the full year of 2024, they did report a small amount of grant revenue, $100,000, but in the first half of 2025, that revenue dropped to zero as they focused on the merger. It seems their operational revenue stream is not yet established. And for the Profusa standalone financials, that same story is there. For the 6 months ending the 30th of June 2025, total revenue was zero. For the entire year of 2024, it was just $100,000. This is a company that is still very much in the development phase. Let's look at the profit and loss for the year ended the 31st of December 2024. Profusa reported a loss from operations of $4.5 million, and for the year before that, it was even higher at $6 million. They are losing money operating their business. Their debt is a big deal. As of the 30th of June 2025, they had nearly $50 million in convertible debt payable. A large chunk of that is from related parties, which means people or entities connected to the company. This debt is not short-term, it all needs to be paid or converted relatively soon. They have a significant amount of convertible preferred stock. These are special shares that can be converted into common stock under certain conditions. The liquidation preference for their Series C and C-1 stock alone is over $45 million. This means if the company were to be sold or liquidated, preferred stockholders get paid back first. and this is a substantial amount. They also point out material weaknesses in their internal controls over financial reporting. This means their systems for tracking money and reporting financials are not as robust as they should be. This can lead to errors and erode investor confidence. Remember that plan to buy Bitcoin, they're very upfront about the risks. Bitcoin is extremely volatile. They mention it dropping significantly in value in the past, and that this strategy could really impact their financial results and stock price. It is a high stakes game they are playing with their treasury. Going back to that going concern warning, it is repeated throughout the document they are heavily reliant on this committed equity facility and future financing to stay afloat. Without it, they might not survive. Another big concern is their stock listing on NASDAQ. They received a delisting notice because their stock price has been so low. A delisting would make their stock much harder to trade and could severely impact its value. Now let's look at the management team. Ben Wang has been the CEO since 2012, which shows a long-term commitment, but also means he has been with the company through all its ups and downs, including the significant losses. The CFO Fred Nechtel is relatively new, joining in mid-2025. His financial background from previous roles is noted as valuable. Looking at who owns what as of late October 2025, the numbers reveal some interesting points. The sponsor Northview sponsor ILLC holds a significant chunk of shares and warrants over 22%. Ascent Partners Fund LLC, the big investor in their committed equity facility, also holds a notable amount. It is a concentrated ownership structure. So what is the big picture here? Profusa is a company with an interesting technology in the medical sensor space. They secured some significant funding through that committed equity facility and have a big business combination behind them. However, the financials paint a picture of a company burning through cash with no revenue and significant debt. The concerns about going concern and a potential NASDAQ delisting are very real. Their strategy of relying on a committed equity facility for funding and then using that money to buy volatile assets like Bitcoin adds another layer of risk. While their technology might be promising the path to profitability and long-term survival, looks challenging based on this filing. They essentially in a race against time and financial headwinds. Alright, that is our breakdown of Profusa's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time. Hey everyone, welcome back to Corporate Decoder, the place where we unpack complex financial reports to uncover the real story. Today we were looking at Profusa Incorporated's latest filing, a report that throws a lot of numbers our way, and we tried to make sense of what it all means for you. Before we dive in, if you love getting clear, straight insights from these thick filings, make sure you subscribe to the channel and hit that notification bell so you don't miss out on future decoded reports. We also have a Discord community linked in the description if you want to join the conversation. So Profusa is in the business of developing medical sensors like those for monitoring oxygen and glucose. They recently went through a major business combination, a sort of merger back in July of 2025, and this filing is giving us a look under the hood at their finances since then. We were talking about revenue, expenses, and a whole lot of risk factors. Right off the bat, this filing is about a lot of common stock shares being registered for resale. We were talking over 42 million shares. This is happening for two main reasons: shares linked to a purchase agreement with Ascent Partners Fund LLC and other shares that were part of a deal for transaction costs related to their big business combination in July 2025. Basically, a lot of existing shares are about to hit the market. Let's talk stock price as of early October 2025. The price was $0.33 a share. That is quite low, and it tells us investors are not exactly valuing the company highly right now. This document itself is an S-1 filing. Think of it as a formal declaration to the Securities and Exchange Commission about the securities being offered and the company's financial situation. It is a crucial step in the process of making shares available for sale. Now, this is a really significant statement. The company is directly telling us that they have substantial doubt about their ability to keep operating. This means they might run out of money or face other major challenges. It is a big warning sign about their future financial health, and it makes it harder for them to borrow more money. A major part of their funding plan involves a committed equity facility. Imagine an agreement where a financial firm is ready to buy a lot of their stock over time, up to $100 million. While this sounds like a safety net, it also means they can issue a lot of new shares, which dilutes the value of existing shares for current owners. Every new share issued makes each existing share represent a smaller piece of the company. And here is where things get interesting. A part of their strategy is to use money they might get from selling shares to buy Bitcoin. Bitcoin is known for its extreme price swings, and this adds a whole new level of risk to their financial strategy. They're essentially making a bet on Bitcoin's future price. Let us look at their financial situation right after that business combination on the 30th of June 2025. Their assets totaled around $14.5 million, but their liabilities were much higher at over $36 million. This difference leaves them with a significant stockholders deficit. This is a key figure that really underlines the concern about the company's future. As of the 30th of June 2025, Profusa reported a stockholders deficit of over $21 million. In simple terms, they owe more than they own, indicating a very weak financial position. Now, for their income statement for the first 6 months of 2025, Profusa reported absolutely no revenue. That is right, zero, yet their operating expenses were over $9 million. This resulted in a net loss of nearly $18 million for that period alone. They are spending a lot way more than they are earning. The report mentions some government grant revenue in 2024 totaling $100,000, but in early 2025 that revenue disappeared, likely due to their focus on the business combination. It shows that their core business operations are not yet generating significant income. Looking at Profusa, own financial statements further emphasizes this point. In the 6 months ending the 30th of June 2025, their revenue was zero. For the entire previous year, it was just $100,000. This company is still very much in the early stages of development. For the full year 2024, Profusa had an operating loss of $4.5 million, and the year before that, the loss was even larger at $6 million. They are consistently losing money on the operations of their business. Their debt is a significant concern. As of the 30th of June 2025, Profusa had almost $50 million in convertible debt. A large portion of this is owed to related parties, which means it is owed to people or entities with close ties to the company. This debt needs to be addressed relatively soon. They also have a substantial amount of convertible preferred stock. This type of stock has special rights and can be converted into common stock. Just the liquidation preference for their Series C and C-1 preferred stock is over $45 million. This means if the company were to be sold or liquidated, these preferred stockholders would get paid back first, and it is a very large sum. This phrase about substantial doubt regarding their ability to continue as a going concern is a recurring theme. It means the company itself acknowledges there is a real possibility they might not be able to operate for the next year without significant new funding. And there is more risk Profusa's stock was delisted from NASDAQ. This means their shares are no longer traded on a major exchange and are likely now on the OTC market, which is less regulated and generally involves lower price stocks. This is a serious blow to liquidity and investor confidence. Let's check in on who is in charge. Ben Huang, the CEO, has been with Profusa since 2012. That is a long tenure showing dedication, but also that he has been there through the entire journey of losses and development. The Chief Financial Officer, Fred Nextel, is a more recent addition, joining in mid-2025. His experience in finance is highlighted as a key asset. Looking at ownership here is what stands out. The sponsor Northview sponsor ILC holds a significant portion of the company's stock and warrants, together well over 20%. Ascent Partners Fund LLC, the investor in that committed equity facility, also holds a substantial chunk. This indicates a concentrated ownership structure. So what is the verdict on Profusa? They have an interesting technology in the medical sensor space and a large number of shares being registered for resale. However, the financial picture from this filing is quite concerning. They are spending heavily with almost no revenue, showing substantial operating losses, and have a significant amount of debt. The repeated warnings about their ability to continue as a going concern and the issues with their stock listing highlight serious financial challenges. Their strategy involving a committed equity facility and Bitcoin adds further risk. Profusa appears to be in a race against time to turn its technology into a profitable business before its cash runs out. Alright, that is our breakdown of Profusa's latest filing. What is your take on these numbers and what they signal for the company's future? Did their tech company background and Bitcoin strategy catch your eye? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate finance. Don't forget to check out our Discord in the description to continue the conversation. Thanks for watching. See you next time.